My name is Scott Forehand, or actually, I should say, hi there. Today is May the 2nd, 2024, and we are here today to talk about debt-free life or infinite banking or private banking. They're all kind of the same things. They have different names depending on which region of the country that you're using or what your training was as far as how to offer these programs, structure these programs, and deploy these programs for clients as financial tools, financial instruments, just traditional life insurance instruments as well, and also as a place where you can have a private bank or an infinite bank, which we'll talk about in just a few minutes. Today with us, we do have Mark Creighton. Mark, Mr. Creighton, please introduce yourself, sir.
There's only a few people can get away with Marky Mark. And hang on, I got to move you guys around again. Only a few people get away with Marky Mark. Yes, I am Mark Creighton. I've been at Mutual Trust for 20 years. I love what I do. It's fun. Permanent life insurance is about the coolest thing there is. Oh, wait, I got a story for you. Got a text the other day. I get contacted from people all across the country. So you guys are all scattered around the country. So I've gotten used to having to pay attention. So I get a text the other day from an individual, and it says, "Hey, we can fund 150, payback 180. Are you available to discuss options?" I'm like, all right. In my world, this sounds like an IBC call. But I don't know who this number is. I go to my Salesforce thing and I can't find this number, but this isn't a first time. So I'm like, I'm sorry, I don't have a contact associated with this number. I don't know who you are, but yeah, I'm free now. That was yesterday. So I get a contact today. I'm Haley, a direct lender with Lock Equities. This is regarding working capital for your business. If you're still interested, please send your email so I can send you an application and get you funded today. My response, I'm really proud of it. No, I use my own capital as a funding source. Are you available to discuss how participating whole life insurance can replace disgusting lenders who rape and pillage their clients' wealth?
Love it.
They have not responded yet. I'm not licensed, so I'll find out where they are, and first one to get a hold of me gets the client.
Yeah, sure. Right on.
So yeah, that's the kind of fun I have. I love talking IBC. I love talking whole life. Now I like talking IUL too.
Right on. All right. So one more thing for what Mark, for that call that you just had, another response that I would have done is say, you know what? I'm not really interested in the money that you have. I've got my own money. But if you're interested in trying to sell something that's official and permanent versus what you've got, let me know. We're hiring.
If you want to feel good about your life,
Yeah.
let me know.
Yeah.
I started kind of down that road, and then I decided to be a little different, snarky. So I'm really not snarky all the time. I'm sorry. I've just made a bad impression to anybody who doesn't know me. So I'm a good guy, I promise.
Right on. All right, so Mark, so first things first. So we usually use this call to talk about debt-free life, infinite banking, and so on. There is an alternate that depending on some people, and so we are gonna talk about IULs for a minute here. And the reason I have certainly everybody's got their own opinions of an IUL, and I do too. And unfortunately, if you do a Google search for IUL lawsuits, you'll find hundreds and hundreds of class action lawsuits out there for IULs that are failing. And the reason why they're failing is because they weren't structured correctly, and the client did not have their expectations managed properly by the agent that wrote that business. So all IULs, unless you overfund them, all IULs will eventually fail. And that's in a vacuum, I think 96% of all IULs fail in a vacuum unless they're really structured to be hyper-funded. And because of the nature of an IUL, I'm telling you the bad first, because of the nature of an IUL where there is a cost of insurance associated with the underlying death benefit in an IUL, the cost of insurance is level. Sometimes it's 15 years, sometimes it's shorter, sometimes it's longer, depending on the carrier. But there is a time when it will start adjusting. And at that point, if it hasn't been structured correctly, the policy will start to fail. It's not that the client's going to have to pay more premium. It's just that in order to make up the premium differential, because it cost $50 more per year or per month this year than it did last year, that money's got to come from somewhere. It's coming from the cash value of the policy. And eventually, cash value of the policy will go to zero. And then the policy they will send a bill to the insured saying, yep, your life insurance policy was $150 a month. Due to the fact that there's no longer a cash value in your policy, in order to keep this policy in force, we need to collect $1,150 a month. And that's usually about how that goes down. So that's the bad about IULs. The good about IULs, you can get a larger death benefit with an IUL in many cases, and you can get cash growth and permanence if you structure it correctly. All right, so Mr. Creighton.
Yes, sir.
Go for it. If I said anything wrong, please correct me, because I've been wrong before. But if I said anything that's incorrect, please, let's get it out there now. And but there are some companies that we have at Symmetry right now that have IUL products, which are being they're good programs. They're great carriers, good programs. But in their current iterations, they're not designed to do what people are trying to use them for. So they're designed to be a death benefit focus only, or designed to be a higher death benefit for a shorter period of time. But people are trying to use them as cash vehicles, and they're not really designed for that. Not all carriers, but some of the ones that are more common here. So I know, Mark, you guys just came out with an IUL. I ran my first series of illustrations last week, and it's very interesting. And you have the floor to talk about your IULs. I don't have anything negative or positive to say yet because I haven't seen enough illustrations. The vote
don't lead with interesting. It's all right. So I have all right. This is what my second call with you where we've discussed IUL, and now I'm gonna proclaim to be an expert, but cut me a break. I've been talking whole life for 20 years. I know a lot about IUL, and it's a good product. They're different products. They're permanent insurance, and permanent insurance is awesome. Really, the difference comes down to what does a client want and what does a client understand. Both policies, when fully funded, are going to perform as expected. Now, IULs aren't meant to create 10% returns year after year. Ask an IUL carrier, and if they're honest with you, they'll tell you no. IULs should give you a properly funded IUL should provide a 5 to 7% return on average over a long term. Okay, that's what it is. It's not the 9.65 cap we have right now. No, if you get 20 years of capping out, hey, great, run with it. That was tremendous. Truth is going to set you free, and you're going to be back down to averaging 6%. You can do better, right? You're protected from market losses. There's that, but you're not protected from age, and you will become more expensive to insure, and that's going to come out of the cash values. And like you said, and I just arranged on the side here, Mr. Simpkin and I are going to talk because he sent me a note yesterday about a client he's dealing with. I think it's just a UL policy, but the problem exists. These things happen. If the expectation isn't right, you're in trouble with the client. I'm going to tie this to infinite banking. There are a bunch of people who want to go out, who are on YouTube right now telling you, oh, no, you can infinite bank with IUL. Can you? Yeah. I'm not going to tell you to do it. We don't want it. That's whole life. Whole life is better. If I borrow from my IUL, first of all, we will not lend out money in the first year on an IUL. We will on whole life, not in an IUL. Second year, I can't stop you. You can do it. But there's a lot of risk to the client. And clients are human. And human nature says, oh, we don't always remember what we were told to do. If I borrow from my IUL next year, in year 2, and I pay, hey, I need a short-term need and my cash is there. I borrow and pay it back in a couple months. No harm. I'm going to be fine. Okay. But if I let it ride and don't pay my loan interest, and all of a sudden there's a year with 0, guess what my cash value does? It kind of goes down. That loan interest is eating away my cash value. I don't have it to use. So that's a problem. There's no guaranteed growth. Whole life, you got guaranteed growth. It is the much better fit for this type of activity. But IUL is a good product. It's built to be flexible and, withstand the money coming out at long term, down the road, not early on. You risk how the policy is going to perform early on. So that's that. Our IUL is really cool. All that being said, our IUL is cool. There's a whole lot of people who have come out, a whole lot of carriers have come out with some really nifty products. They're fancier and fancier. Look at this gadget on the look at the gadget we put on this one. Look at the gadget on this one. For some strategic business reasons, we got into the IUL business. And why I am new, why Mutual Trust has never touted an IUL, Pan American, who we really are, has. We've been doing IUL business in the international space for a long time. All I'm telling you that for is to put your mind at ease that, oh my gosh, this is the carrier that I might actually be able to do this. They're not completely brand new. What we had on the international stage is not very competitive. You wouldn't sell it. So I am part of Mutual Trust Life Solutions. We are the individual life distribution unit for Pan American Life. So we work the US. They're going to give us a product that we have to market. We told them, oh, it better be good because you're going to expect us to create, say, like we're going to have to report sales numbers on this. We know that you have a number of carriers to go to. We looked at all those carriers and say, it's got to compete. We also looked at it and said, it's got to stand out. So instead of trying to create, invent a new feature, we said, you know what? Let's go back to basics. There hasn't been a simple IUL introduced in 15 years in the market, as far as we can tell. And one of your carriers just came out and we were internally chuckling a little bit about their simple IUL with a 60-page illustration. Ours is simple with a 16 to 20-page illustration, 3 indexes. What you see is what you got. Market goes up, you participate. Market goes down, you don't participate in the losses. Variable or fixed loan rate, you choose what you want. That's it. It is what it is. As new agents, as you guys think about building out your team, this is a product that you can get an individual up and understanding quickly. And the best part is we're Mutual Trust. Nobody's heard of us, right? I know you guys all know us really well. Nobody else has heard of us. Nobody else is recruiting to this. So when you look and you look around the marketplace and say, hey, I've got a carrier for you that's got a product nobody else has. This is a great product. It's something that can be strong to recruit to. You can get an agent up and active where maybe it would have taken them a little longer. Now, all that said, simple is great. Simple, straightforward, easy to explain to the client, easy to understand as an agent. It's got to perform, right? Because we're not stupid. We're not going to come up with a product that at the end of the day, we know what you do. You grab ledgers and you go, huh. So we made it competitive across the cells, across all the different carriers we targeted, including some big names who are considered to be some of the best IUL carriers out there. We compete. If we're not number one in cash value, we're not far down. We're top 5. If we're not number one in income projections on the backside, we're not far off. Best part is our targets are excellent. So it performs for your clients and you get rewarded for the work you do for us. And you get summit credits and all that good stuff. Educational reimbursements, all those things we like to do.
We'll talk about that too. Can I stop you for a second? I want to ask you a couple of questions about the IUL.
Yeah. See how good I got.
So, and I don't want to do softballs, but these are questions that people who are looking at an IUL, who understand how IULs work, should be asking. All right. So with every IUL illustration tool out there, okay, for every carrier, there's a number that those carriers will make their non-guaranteed projections show. Okay. I've seen it as high as 12%. The average for some of our carriers, I've seen it up at 9%, but that's not realistic. So we know that realistic is between 5 and 7. So do you happen to know off the top of your head what your illustration rate is?
6.13 Standard & Poor's.
There you go.
Yeah, and here's one of the things about simple too is you've got those illustrations and they're projecting. I've seen a couple. We've got 3 to 4% more cash value at retirement age, right? But they're projecting a much higher income than we are. That was one of the illustrations. Well, I also know who that carrier is. I'm not going to tell you who it is. I can show you a presentation, but I know how they got there. There's all kinds of fancy bells and whistles that are going to happen. Those are trap doors. I work for a carrier. I am going to admit something. A carrier will not do something it doesn't have to do, not without a trade-off. If we're guaranteeing a bonus, but our numbers, our investment income doesn't support that we can pay that bonus and still make the profit we need to make our stockholders happy, or make, provide good dividends as we would. We don't have stockholders. Something's got to change, right? Well, I promised you 1%. Guess what happens? What changes? Cap.
Ah,
So I have to give you 1%, but I'm going to lower your cap. I have a very good friend who used to work at an IUL company. He knows them well. You know who this IUL company is. I don't think it's on your platform though, but you all know who they are. Used to work there as a regional VP. He has been an IUL expert. He is, he is happy as a pig in slop right now that we have an IUL. I kid him all the time. But he'll tell you his policy. He's got bells and whistles and he's got things they have to do, but his cap is down to, what did he say it is? I think his cap is 5. It's like, why is my cap 5? They can't answer that. He knows the answer. He knows the things they put in place. Things like a capped loan rate. Don't kid yourself. Loan rates are based on the same thing we base our whole life loan rates on, which is what our portfolio yields on our bond investments. IUL, they're investing in bonds. If the loan rate is lower than what they're getting in their investment, that's money out of their pocket, but they can't change the loan rate to match what the market says it should be. What changes? Cap. Trapdoor. All these little fancy nuances are trapdoors that put undue pressure on the cap. Are our caps going to change? Yeah, it has to. That's the IUL world. But the only thing that's going to change a cap are the things that should change it. What are the cost of options? What are these things? Not a guaranteed bonus, not a provisional guaranteed bonus, which if it's provisional, how is it guaranteed? Not any of these other things. Simple, straightforward, no trap doors. What you see is what you get.
okay. So I would like to open it up if anybody has any questions for Mark about the IUL. And then I want to talk about some strategy, how to incorporate infinite banks using multiple tools, not just, and we don't, to preface this, first off, I don't see anybody with their hands up, so I don't see any questions. So that's why I'm just going to jump into it. There are some companies out there and there's a big one, okay, with a big tall building and some, it might even be Chicago, that has a company whose sole job it was to sell infinite banks using a specific IUL. And the problem with that is some of the things that Mark's already said. First off, the loan, how early can you touch the money? Second thing is, if you're using it in IUL as an infinite bank or a debt-free life strategy, I can't tell you how much money is going to be in there because I don't know what the return's going to be. You have a variable return. And one last thing, just to shine the light on this, one of the things Mark just said is about the cap. Okay, so if you have two programs, one has a guaranteed interest rate, and one has a lower guaranteed interest rate but a cap, the minute the program has this move up, then this is an IUL, this is a par whole life. Okay, the market goes up 3%. Both of them go up 3%. The market goes up 6%. This one goes up 5. This one goes up 3. Right? The market stays flat. This one stays here. This goes up 3. It doesn't take long for the guaranteed interest rate to start outperforming the one with the higher potential gain with the cap. And that's the part that we're talking about. And then finally, what happens 15 years down the road? Okay, 15 years down the road, cost of insurance is the same for the whole life program. The cost of insurance for the IUL just went up, and it starts adjusting on an annual or every 5-year basis, depending on the structure of the IUL. So now market went up 5%, but my cost of insurance pulls it back. I went up 3. Market went up 5%, cost of insurance pulls it back. I went up 3. So at that point in the later stages of an IUL, the growth that you think is going to be there may or may not be there. But what I can tell you is the cost of insurance is going to go up. And if there's a cap, that cost of insurance is going to eat away at the gain that you are allowed to have. And then all of a sudden, that par whole life is going to start outperforming. Does that mean you shouldn't use it? I don't think so. I think that if the age is appropriate and the goal is appropriate and we're using it for the right reasons, and IUL is appropriate. It's not appropriate for a 65-year-old though, even though you might be able to get them approved. It's not appropriate because if they're we're all living longer now. So if they live to 81, that's 15 years. That first year is going to be a killer as far as that growth is concerned in the cost of insurance component. And unless they've been overfunding the heck out of that IUL, it's probably going to be at risk of failing in probably year 20 or 22 or something like that. And that's what I've looked at those programs. That's about what seems to happen with some of those tools. Now, as a point of opportunity, if you have someone that's coming to you and they say, yeah, I've heard a lot about IULs, I really want to do one. Don't talk them out of a sale, but you should distribute their risk and their growth with maybe you do 2 programs. Maybe you do one par whole life, one IUL. You give them the higher potential growth, and they'll see 10 years, 15 years, if they've been overfunding this one versus this one, it should be bigger. But then they're going to start seeing the rate of growth decrease, and then this one's going to slowly take over. That's my take, Mark. Am I missing something?
No, it's let's pretend it's 2022. That's the last year I can remember having this happen. So I've got a 401k. And I get an email update every Monday morning between 8 and 9 a.m. It's an email that tells me how my 401k is performing this year. So in 2022, it was horrible. I'm like in a good S&P fund. Like I really like it. It's performing. I'm pleased. But 2022 was ugly as crap. What if I was retired in 2022? What if I was using my IUL instead of a 401k? That's market based, right? Yeah, cool. I'm not losing cash, but I'm not growing cash either because I'm down. I don't know. The year finished at 22% under, right? I lost 22% in my 401k. My IUL wouldn't have lost
2022, the S&P
22%.
lost 19.6% for the record.
Okay. So mine was a little worse because it's, I don't know, whatever S&P I'm in, it was 21, 22, somewhere in there. Anyway, halfway through the year, I can see that this isn't trending well. Nothing's changing. I'm -7, -12, -14. I'm taking income from something. If I've got an IUL and a whole life at that point, I've got an option. I don't want to take money out of my IUL anymore. Hey, I did it for the first few months, but I was kind of hopeful of a little rebound. I'm going to shift where my money's coming out now. I'm going to turn to my whole life policy because guess what my whole life policy is going to do? Do. Doesn't care what the market is. My guaranteed cash values are still growing. So I've got gain that I'm drawing on. I don't have no gain that I'm drawing on. So it can make it better. It is the buffer in retirement. Whether your clients are heavily invested in 401k and everything they have is qualified and market based, maybe IUL isn't the right product for them. You ask the question, how much of your retirement is guaranteed? You look at a client whose all they are is guaranteed. Hey, maybe there's an option for some upside growth and a tax-free income that they can have in retirement. Maybe that's better. Is there a reason they're one or the other? If it's just if there's just blind diversification, everybody should be diversified. It's one of the first lessons we all learn. Are you properly diversified? Now, it's preferential. Everybody's got taste. you're like, no, I don't like risk at all. Okay, that's fine. Should there be some? Look at what it can do for you. Or, you're all risk based. This is what's going to happen to you in retirement. See, if you haven't ever looked up the effects of sequencing of returns, spend some time Googling that and take a look. If 2022 was your first year of retirement and all I was doing was relying on my 401k, I'm going to be screwed a whole lot earlier. It's not going to project out what it was supposed to. Pardon my French.
Yeah.
It's not going to project out like it was supposed to. They say you plan on 4% every year coming out. Well, that I just shaved about 6 years off just from 2022. So it's just something to consider. We like having both products. Again, permanent insurance is awesome. Which product is right for the client in that for that client in that situation? That's the product they should buy.
All right. So if you're playing along at home, the thing that you should have taken note of, it's all important, but the key thing there for your practice, for your business with your clients, is being aware of that risk that Mark called sequence risk. Okay. So that has a couple of different connotations, but sequence risk is real. Okay. And that's one of the reasons why you should be diversifying for your clients. Last thing before I see Scott Simpkin had a question, but I want to just put this bug in your ear. When you're going through this process and you're finding out what the client wants to do, why they want to do it, what their needs are, what their goals are, and all those things that you're supposed to do as a planner agent, okay? If we find out and get to the point where we understand where everything goes, where we're trying to have some upside gain, but we also want to have some permanence, and we've established the capacity for the client of maybe $500 a month, okay? Why not do an IBC with 110 base, do an IUL with 110 base, and then split the balance, which is 280, split it 140 each into both products. And that way you're still utilizing the $500. You're putting the client in a situation where you've got two different programs working for them. One has a higher potential in the short term. One has a guaranteed permanence. And then you can look at what happens in the 15th year. This is how I do it. Look what happens in the 15th year, see the cash value, and then I'm going to move the money from the IUL because I know the IUL is going to start getting more and more expensive. I'm going to move the money, take the cash value out, put it into my IBC, and then keep on moving. And that way you're getting advantage of the increased growth potential because of the market indexing, and you're getting the permanence from the whole life, our whole life. All right. I see you shaking your head, Mark. I guess you agree with that strategy?
I love it. And if I'm not mistaken, especially if you're thinking about a DFL client, and you got to think about it, you got to get them out of debt, and you got to figure out what's the most efficient way to get them out of debt. So we may structure the policies different, but you've just created two receptacles for their freed up cash flow. You get it out of debt, they start out paying $500 a month. A couple debts later, now they're paying $800 a month into their programs. You address the debt, you address their retirement.
Yep. Yep. There's
Awesome
nothing that you can't
solution.
write two policies in one person. All right, Mr.
Underwrite at the same
Simpkin.
time. Yeah.
Well, a couple of things. One, was the sequencing of returns, but before we get to that, I was trying to remember the guy's name. I had a client who came to me.
Don't use any names on this channel. It's being recorded.
No, I won't. I had a client come to me and he's like, I'm trying to learn how to, get out of debt because I explained it to him last year, but he was too smart and he wanted to use his HELOC. Well, then the HELOC changed from 2% to 8%, and he calls me and says, maybe we should talk. So we start doing a DFL on him. But he says, I've been watching all this stuff on the internet about how to use IULs to do it, and you can make, 20%, and that you ought to be able to make 20% on an IUL and use it. And you probably know who I'm talking about, the guy he's been watching because he's all over the internet. But anyway, I watched a couple of this guy, and I'm like, well, he's got some of it right, but he certainly doesn't have that right. And of course, it's a tool, but it's not the right tool to use it. And so my question to you guys is, how do I know how I handled it, but how would you handle that? Like, hey, this guy says I should be getting my IUL should be getting, 15, 20% minimum. All my clients, this guy goes off, I've been doing this for 25 years, and all my clients get, 15, 20% a year, or, and they always have, and blah, blah, blah.
So Dave Ramsey has a twin brother selling IULs, huh?
Yeah, this guy's on steroids, let me tell you.
Well, all right. So there are uncapped IULs out there, but I will tell you. So I used the phrase before, trapdoors. IULs are meant to create a 5 to 7% return for the client. That's ideal, right? Not guaranteed. If there's 20 years in a row of zero market performance, you're not getting that. But history suggests that's not going to happen. 5 to 7 is a realistic number. So your IUL that's going to give you 20 on an up year. Guess what comes with that? A fee. There's a fee. There's a fee every year. They're going to charge a fee to have that uncapped product. So what happens in the year where you don't get 20? Hey, it's okay if they charge me 3% of my account value because I got 20. So 20 minus 3, I got 17. I'm great. What happens when you get a 3% return in the market that year, or a 2%, or a 1%, or even a 0? Oh, that 3% is still coming out. You're paying for it. It's a trapdoor. The same thing goes with, this product has a 240% participation rate. There's a cost to it.
What's the cap?
Might be a lower cap. It's something. It sounds awesome, but really, is there some secret in the industry that they know that nobody else knows? The answer is no. They don't. It's a gimmick. It's a gadget. It looks sexy. It sells well. It's a fancy story. And these people on YouTube, it's scary because they get 80% of things right. And these are people who talk about whole life too. These are whole life guys too. IUL, whole life. They are all dangerous. They are dangerous to your profession. They hurt you every day because you get a client who says, yeah, but I saw this. And now you got to be like, oh, the guy's an idiot. And now you got to explain it away. They are bad for the industry, and probably nobody can do anything about them. I mean, I am convinced several of them don't even hold an insurance license.
Years down the line, they'll get sued and use your
cannot stop them. If they don't hold an insurance license, there's nothing anybody can do about it. One of them.
Someone could do a lot. Someone could sue them because they took their advice online and they presented it as themselves as an expert. They can file a lawsuit, and then they'll have to defend themselves or they'll lose the lawsuit. So there can be a repercussion, even though that may not be that they lose the lawsuit.
Yeah.
There is that.
I'm countering that argument with well, okay, your agent who sold you that, you have him explain all the moving pieces. Tell him exactly what's part of that product and where and if you're actually going to get 20 on a regular basis, and you can count on a double-digit long-term return. Explain how. And if he can't do it, call the carrier. Ask them.
Yep.
They won't. They can't do it.
Yeah, so in the end, an IUL is a tool. It has an appropriate use. It is an age-related appropriate use, and a distribution timeframe determined appropriate use. It is not one size fits all like people that are out there TikTok and Instagram and all that stuff saying how great IULs are, because they're not. They're not great for everybody. You can ask those people that are in those class action lawsuits right now how well their IUL is for them. And were they told by their agent that it would be permanent? Were they told by their agent that it was going to have a ton of money in there? And were they told by their agent, oh yeah, and in the end, you're not going to have any money in there, but now your premium is 1,000% more than where it started just to keep the death benefit going? That's the seedy side. And I'm going to be, I don't think those agents that wrote that stuff did it nefariously. I don't think it was intentional that I'm going to write something that I know I'm going to get paid on and I know it's going to fail for you, but I'll be out of business. I don't think they had that thought process. I'm pretty sure they thought they were doing the right thing. I think that their training and maybe their deep dive into the math about how those things really work, I don't think that was there. And I don't think everybody has the capacity to do that either. So, anything else about IULs for Dr. Mark Creighton? Okay. All right. So now what we're going to do is we're going to talk about advanced uses of some IBC programs, right? So I did this presentation a while back where we talked about capturing capturing the interest and taxes component of a mortgage payment. So you can't do this with every mortgage. You can only do it with conventional mortgages. So if your client has the capacity to set up a conventional mortgage where they're paying their taxes and their insurance payment themselves, then this is a great vehicle to capture that. So here's the math. Looking at this from a savings account perspective, if I'm looking at if I put $500 a month to go in a savings account, because at the end of the year, I'm going to have to pay $6,000 in taxes and insurance. Then I've spent that money exactly one time. I've made maybe 0.5% or maybe 1% net on that because I had it in that savings account at least periodically over time. Maybe I've made a little bit of money. Well, what happens if I put that into my IBC? So if you've got an IBC that's got a 3% guaranteed growth, then you make 3% year one. What about year two? I make another 3%. What about year three? I make another 3%. Is that better than just making the 1% one time? Of course, the answer is yes. But now here's the trick. It's not a trick. It's just a math thing. If I put the money in and then I take a loan against it, which is what we're talking about. In an IBC, we're not talking about taking out your principal. We're talking about taking a loan against the cash value. Then I'm going to have a delta of a net interest cost. The net interest cost would be 2.1% currently. That's 5%. That's this many. Guaranteed gain and 5.1% current loan cost with one of our carriers. So in that example, 5.1 minus 3, your net cost of money is 2.1%. So now if I know that I'm going to pull 6,000 and I know it's going to cost me 2.1%, then in order for me to stay neutral, I have to fund it at least 2.1% more, but that's not what I'm going to tell you to do. I'm going to tell you to do much more than that. Okay, so we're talking about $500 a month times 12 months at $6,000 times 0.01.021 is, so really in order for me to have a neutral position to put money in, take money out, pay the taxes and insurance payment, I need to put in at least $6,126. But that's because you don't get 100% access to your funds on day one. You get 100% access to your funds, real writing of that client. And it can be in some cases years before the full value of what you put in there is now realized. If it's a standard rating class, I'm going to tell you, and it doesn't have to be just taxes and insurance. And you have to pay it again next year. You have to pay it again next year. So in that example, I'm saying realistically, so if I put in $6,000 times 15%. That means I'm actually putting in $6,900. At $6,900 gained, if I have access to 90%, I can pull out $6,210. I only need 6,000. So that extra $210 that I'm not pulling out, it's still there. That means I'm getting a little tiny bit of extra growth, which means I'm not getting the program so far out of whack that it's going to fail. And that's the key here, folks. So that that thing that I'm talking about capturing just the taxes and the insurance payment portion of a mortgage, you can use that for anything. It could be used for your income taxes. So if you're a 1099, if you're a commissioned salesperson and you receive a substantial portion of your income as a 1099 where you're going to have to pay the tax on it eventually, okay, you know what your tax rate is: 22,000, 24,000, 22%, 24%, 12%, married filing single, married filing jointly, whatever. You can look up your tax rate and save that amount of money. Put that money that you're going to have to pay the IRS at the end of the year, put that money into your infinite bank, but put more than what you need, because it's one thing to owe the IRS $70,000. It's another thing to have put $70,000 into your infinite bank. And it's another thing to only be able to withdraw 63,000. Now you got a problem. All right. So that's kind of the lesson about using infinite banks in cash flow situations, which is you want to overfund beyond the need of what you know you're going to need. Need 6,000? Don't put in 6,000. Put in 6,000 plus 15%. And that's if you're a standard rating class. If the client gets a rating class of 5, you can still do the program, but the efficiency of the dollars is not going to be there. And you're going to have to, if you're going to use it as a cash flow bank, you have to put in even more than 15%, probably as much as 30%. Any comments on what I just said, Mr. Creighton?
Yes. Let's talk about the table rating for a second.
Okay.
You get to a client, and I've had too many conversations with agents who are so focused on the cash accumulation side, and we love it. We do a lot of it. This is half of our sales, and the beauty of permanent insurance is we talk about it different than how insurance was really supposed to be talked about. It's a death benefit. Well, we got all these cool things like paid up additions and excess premium and all that, and the products that we have, it can do so much more. The living benefits, as you say, you get to a client and you find out that they're table 5. This is a conversation that you sit down with the client and say, Mr. Client, Mrs. Client, life's not guaranteed. And right now you can lock in death benefit. Yes, this program isn't going to be as efficient as we thought it would. But the important thing here is look at this column over here. It's the one you guys don't ever talk about. It's the one that makes this all work, which is the death benefit. This is here for your family today. And yes, it might take us 2 years to be really efficient with our personal escrow account. It may take a little bit longer to be perfect with that, but we've got protection. The greatest wealth building tool for families in America is and always will be life insurance. Pivot off of that. Do not let that stop you. If you're stuck and you're like, hey, I got a table rating, what can we do? Call me, call our sales team. We'll help you navigate that. We'll help you through options. And this, oh man, I said this earlier and now I caught myself. Oh, shame on me. Just to repeat it, to keep the suspense. Table ratings aren't a death sentence. That's terrible. Table ratings aren't permanent. Mutual trust, at worst, we will drop the table rating after 20 years. So if your client's 45 right now and they get to retirement, no worries. Table rating's gone. Automatic. You don't have to do anything. It falls off. A table rating can be amended. Depending on what the table rating is for, you might be able to have your clients apply for a rate improvement as early as 1 year later.
Let me talk about that for a second. I actually have a client we did that with. So I have a client that when we did the application, they were a smoker and overweight, table 3. 2 years later, they had lost 100 pounds and had quit smoking for 2 years. Standard. and they amended everything.
So, motivation to get in better health,
Sure.
or just, hey, let's, if the client is motivated to get better, if they're taking their health seriously, this is, again, it's not permanent. It is if they don't ever change and if they don't ever do anything about it for 20 years, but that can be changed.
Right on. All right. Anybody have any other questions while we're still here?
I have a question.
All right.
Table rating. Okay,
Yeah.
so you get to that point and they approve that the rating's going to come off. Okay. So is it re-rated at their age at that time, or does it still adjust the premium based on their age when they?
So in the whole life, the new
Goes up.
premium is based on the attained age.
Age, that's right. So
Yeah.
I was just thinking it was.
Yeah, and also when you do that, they're going to have to go back through, and they're going to have to their business informatics folks are going to have to do a recalculation and a recasting, because especially if they've been max funding it at a specific rate, because then there's a potential of a mech creeping in. So they're gonna recalculate to keep it as a non-mech unless you tell them otherwise. Did I say that correctly, Mark?
Very good. Very good. I didn't even have to say it. Yeah. So yeah, that can happen, and it's happened. But there's workarounds, and don't be scared of it. It's perfectly fine and everything's good.
Yeah, mech is not a bad thing if you know how to use them.
Mech is not a 4-letter word.
Yes. Yeah. Hey, Mark, you're going to be speaking about that, aren't you? Coming up here in June in Hopewell,
I'm
Virginia.
speaking about stuff. I
Yeah.
talked to baby Ruth the other day. I got to talk to you as we approach this.
Yeah. Yeah, we got a lot. Yeah, we got. Yeah, we're pimping Mark out. All right. Anybody else have any questions? There's no reason for us to stay here till 7 o'clock tonight if we don't need to. Everybody can go get some dinner. Any last minute questions for anybody?
I got a million, but all of a sudden I can't think of any of them.
Right on. All right. Well, look, I appreciate everybody showing up on a Thursday night. Hopefully, you got something out of this. And that's it. And if you are an agent and you're looking to get your increase your skill set in this industry, we have the workshops coming up on June 6, 7, 8 in Hopewell, Virginia. And there you go. And if you are within 2 or 3 hours of Southeast Virginia, Virginia Beach, we have a corporate overview and training coming up next week on Thursday in Virginia Beach, Virginia. And so that's it. Thanks, everybody. Have a great night. Thanks, Mark. Appreciate you as always. Thank you, Adele. Thanks, Augie.
Glad to be here.
Guys.
Thanks, Scott. And thanks, Rashad. Have a good night, everybody. Bye.
Thanks, guys.
All
Really
right.
appreciate it. Bye.